Thanks, Mai.
Hi, everybody, and welcome along for today, the 6th of February, 2022. As we all know, that means we're closing in on Valentine's Day. So welcome along, and we look forward to your company today. Special show today. Always good to have Ainslie Clubb with us. He's going to be talking about gold and oil today. We'll have a recording from Gordon, who's pretty excited about the volatility of stocks. We'll be hearing from him afterwards. I'll introduce Ainslie, then I will introduce Ainslie again, then we'll do the Gordon recording a little bit later on. It comes in a weekend where we've seen the market continue to push up in the crypto space. Bitcoin up. I would suggest what I've seen many of the altcoins in the crypto market rallying after a pretty long, solid sell-off. So we'll be interesting to see how that plays out in the week ahead. But really, we're not here to talk crypto. We are here to talk gold and oil, and that is why we have our gold and oil expert with us. Ainslie, can you lead us away with gold? Interesting market. Boy, it every time I think, here we go, here we stop. Then here we go, but we stop. What's happening this week, Ainslie?
What can I say about gold at the moment? Seasonals indicate that it should be rallying. It should be doing all sorts of things at this time of the year, or December, January. And as you have been off for the last couple of months, so it's nice to see everybody back here again. But let me just share a screen of my darling gold, which has done very, very little, unfortunately, everyone. What can I say? Every time we thought it would break out, it's come back in. It's consolidated, it's got its hopes up, and then the hopes are dashed, and it's just been backwards and forwards. And even if we flick across to a weekly chart, let me just pull down the weekly chart. I think it's even more indicative of how much gold has gone nowhere since pretty much the beginning of last year. Let's just say it had a bit of a hissy fit, flew down and came back, and it's basically for the last year and a bit now has stayed well within this little area here, with the majority of it just flicking between. Now this is even with talk of inflation. This is even with talk of all the other bits and pieces that are happening in the economy, that the US dollar is not doing well, that bond rates and bond yields were at one point net negative. So that should have pushed gold up as well. That hasn't happened. But one of the reasons I'm showing you from a technical point of view is look here on the weekly, and it's even scarier. You see, this is the pivot. The pivot, that is a monthly pivot, so a really, really strong level. Monthly pivot is joined now by the 20 EMA, the 50 EMA lying flat as a dog. Look at MACD. Now, if anybody knows about a MACD has been flat as, that indicates no momentum, consolidation, going nowhere fast. ADX, the DAI plus and the DI minus, both pointing down. ADX down at, actually it's technically about 14 on the daily, but it is going nowhere at the moment. Now, all I can do and all I can say is I'm waiting and sitting patiently at the moment, because when gold does go, it will go. It will be a default mechanism for a lot of things. As you can see, even over on the 4-hourly chart, last week it was impossible to trade. Even trying to pick something, waiting for that second bounce up, and that would bring you straight back down again. Or you had non-farm payrolls, which were, and nobody can guess non-farm payrolls at the moment anyway, so it doesn't matter. But down it went and up it came back again. So at the moment, Paul, what we have here is basically a very wide berth to be given on my beautiful gold, and we'll just have to wait for the right set of events for it to turn up, and then we'll be good to go. But at the moment, it is a no-go zone.
I like what you say, Ainslie. I think it's a really valid point. You know, one of the things with gold, often if you put a line from one end of a range to the other and then put it up or down, the longer its range, the further it goes. And this has been a decent range. And the probability here that when it pulls out of it, it's going to go a fair way, I think is a really good comment. And look, as traders, I guess you've got this, surely people aren't replacing gold with crypto. Surely they understand that that is taking a very stable asset and replacing it with a very unstable asset. And to do that as a hedge against bad times would appear to be foolhardy. So I've got to assume that there's something else at play, and we will see this recreate at some point.
I agree. And look, the difference between gold and crypto is there is no intrinsic value. With gold, there is an intrinsic value. It does have value. It does have store value. So they're the deciphering. That is deciphering for me. Major reason. I'm not saying crypto isn't an asset class that could be used for something else, but given the volatility of crypto, beginning of last week, they were saying, oh no, this is the end of crypto. Anything below 32, and we're going to just see it disappear. It didn't happen at all, and it rallied on the week, over the weekend, and I think it started to do the rally. It started to rally Friday, when gold was still trying to work out what day it was. So I don't think there is a correlation. I don't think one's replacing the other. I think they serve two different purposes at the moment. And at the moment, as you said, when you see a large period of consolidation with gold, and then it finally gets its traction, it will go. It will go. And it's just a matter of being patient and waiting for it. I mean, I've tried a couple of times to get in and been cut fairly badly. As you can see, I mean, totally inexplicable moves up and down. And it's just, at least with oil, I've got a better idea of, Russian troops assembling, or a landslide, or whatever in Nigeria. So if we've got things happening, I can understand it. With gold, oh gee. So patience, and patience.
Yeah, look, it's great advice, Angie. There's patience, isn't it? And look, one of the things we're doing about gold as well is that gold loves levels. And when it finally does break this level around, 1680 with a bit more decision, 1660 will come into play pretty quickly. 1860 will come into play pretty quickly. Sorry, yeah. We're not
at 1660. No.
I think we're doing crypto. We're just dropping at 10% in a couple of hours. Look, that is gold, and I'd like to introduce you again. We can go to Gordon's video. Maybe in future we'll do Gordon's video, and I'd quite like to stay with you. Look, yesterday morning I was catching up with a trading friend of mine from overseas. You know of him, a guy who works for a major fund as an analyst, and he said to me, "Oil's going to go to $200."
Oh, I thought, yep.
Jeepers creepers! Do you know the first thing I thought, Ainslie? I thought, I'm going to buy a hybrid. I'm going to buy a hybrid. I can't. $200 cost me. I'm following up my car every weekend, but he was pretty clear, and it's his area. He's bloody good at it, and I thought it was really interesting. And what we're about to do, Ainslie, is if you're a trader and you're just jumping in now and having a look, and I'm about to ask Ainslie to talk about oil. Before you watch this, go and have a chat about the things she's just done on gold, and have a look at the difference between what a sideways or ranging market looks like versus a trending market. See the difference in how markets extend and go sideways. Right now, oil is the hottest thing in town. Over to you, Ainslie.
Go to oil. Let's flip over to oil. Now, it's been an interesting thing to a commodity to trade. I mean, look at that. Isn't that? That's just beautiful. That's lovely. Again, I mean, we tried to get in, and we had a quick move up on oil on Wednesday night, I think it was. Clicked us in, but that move was too quick for my liking, and I put a warning out to say, quick big move on oil normally means a very large retracement back down again, and we got that. So hopefully, and then we just sort of drifted down a little bit before an OPEC meeting. But you can see here, and priceless examples of quick flick up, big retracement down, quick flick up, big retracement down. That was a bit more of it just hit the wall with that level of consolidation, and back it came down. So when we had a bit of a move out, these are the inventories, and there's a bit of an issue with inventories at the moment. And we had quite a few layers of things happening as well with, like I said, Russian troops assembling at a border, and Russia is one of the larger OPEC plus countries that are producing, and they're trying to flex a little bit. That will have an impact on oil and natural gas prices. Nigeria had some issues. There was a landslide in Ecuador. So a lot of the oil producing countries during the week had, towards the end of the last week, had a few little issues. But one of the biggest things that is coming is a cold snap is expected for the Northern Hemisphere. Now, what that means is heating, and oil is required at the moment for heating. So up went the price of oil. But let's look at the daily chart, shall we? And we came in and basically kissed the R1 level, first resistance level on the monthly chart, and it just went there, turned around and came straight back down again. And we closed the week at around, was it 91 point something, 91.94, but we did actually clip $93 on oil. Now, I know at our Christmas show, Paul asked me where I thought oil was going to go to next, and I said I am not going to be surprised if we see it at 125 soon. We're on our way, aren't we? So here we have just this beautiful technical chart where we have a ring low, off she goes, a pullback, off she goes, a pullback, and up. Be careful of levels. It does get to R1, R2, and it will hit it and come back down again. And I know that went to 93.17 because I had a target of 93.10. I got in on a very fast moving with those news items of what was happening in Nigeria and Venezuela and Ecuador. I got in on those, and it just moved really, really quickly on Friday night. So that sort of hit target around, I think it was around 2 a.m. So, if you're going to set targets on oil, and make sure you use your stops below swing lows, and your targets are use R1s and R2s. They are really safe bets. But once you get a setup, if you are trading oil, make sure you have got one ear on the news. That's always a big plus. And the second one is just watch when you've got those areas of consolidation like we had for the last week and a half. And then she cut loose and off she went. So they're the things to watch for with oil. So I'd expect a bit more of a consolidation back down, or a retracement back down, and maybe check down here first, around the 91 area. And yeah, we then expect a bit of congestion around that R1 before it keeps going north. I just can't see it taking a nosedive, especially with everything that's happening at the moment. Cold snaps, war, landslides, you name it. We've got it all happening.
Reopening after COVID, while New Zealand's looking down at the moment, the rest of the world is opening up. Big markets are opening up, aren't they? US, Europe, they're trying to get on with the world, right? They're trying to get people back doing things, and that's all good for oil, right?
Oh, it's good for oil and for airlines and things like that. And economies in general are just starting to crank back up again and get going, and they can't be closed forever. They're talking about, even in Australia, we're talking about, and after New Zealand, we've done our share of lockdowns and border closures and being really tough, and they're talking about opening the border again next week to international visitors.
Yeah, we're opening the border to you guys in 3 weeks.
Sorry?
We're opening the border to you guys in 3 weeks.
Yeah.
Keep your masks on, stay away from us, you Aussies. Hey.
Oh, look, somebody's going to bring it over in bulk, and you're going to get nailed at some stage. But yeah, I don't know about you, Paul, but everybody's just a little over it and just like, oh, Omicron. And our numbers have actually come down substantially here on the eastern side, on the eastern seaboard. and it's just one of those things. Some people are getting sick. Kids in general are not getting that sick. They're getting it and having it for a couple of days and shaking it off like a head cold, like kids do. Parents just apparently flat out gone down like a sack of potatoes, but that's all part and parcel of it, right? We're just going to have to get on with it. So we'll see what happens.
Conversation for another day, Ainslie. We really
should. See where we go. But as they said, it's part of the economy cranking up, but everybody's trying to crank back open and get going, and that will have an impact on oil.
I think, the point is some of the bigger markets in the world are well through it, or believe they're getting through it. They've been in it for a long time, and I think they're coming out of the side. Other markets, still in the middle of it. Other markets just coming out of it, and other markets going into it. But the smaller markets seem to be going into it. COVID just got into, I think, Tonga, maybe even into the Cooks, into New Zealand. A couple hundred cases a day here. We're going to be doing going the other way. I would imagine doing a bit less, but we're not going to affect the sort of cost of oil. When New Zealand closes down, no one's going to care. I remember having a conversation about oil at $8 and saying, in fact, I remember having a conversation at $20 and saying, you just got to buy oil. You buy it at 20, you buy it at 15, you buy it at 10, you buy it at 5. But you just buy it here because it can't stay down here for long. And if you did that, you should have done bloody well. Thank you for that, Ainslie. Always great to have your views on it, and always interesting to see two such contrasting markets, not only in the period that we're looking at, but really for the last 12 months, where gold's gone sideways for 12 months, and oil generally has gone from $8 to $90 over 12 months. It's gone a long way over a period of time, hasn't it? And it's interesting to, good to have both options available, right? If you're just stuck in gold, it's tough, but if you can get into this as well, boy, you're okay, right?
Yeah, it's been okay, and it's been quite a technical chart as well, which is quite nice. Which I quite, as you know, I quite like the technicals and things balanced and neat and tidy. And it does. Like I said, though, you've got to. One of the idiosyncrasies with oil is you have a big, fast, quick move, you will generally have a big pullback. But what happened on Friday was a big, fast move, but there was just these layers of news just coming one after another, and it just all happened and it just exploded. So that's why I expect to see a bit of a retracement at the beginning of next week before a move up again.
It'd be interesting if it kept down on open. If it kept down on open, it'd be pretty good buy, I'd have thought. We'll wait and see. We will wait and see. Thank you very much, Ainslie. Much appreciated.
Thanks,
cheers, Ainslie. Next up, we're going to have bring on the recording of Gordon, our stocks expert. He's going to come and talk stocks, the US market, what's going over there with the extra volatility. Look, great to have so many people in the room. It's wonderful to see so many of you. Remember, next week on TTR, we're on the Sunday market analysis show, we will have back with us. We will have Lloyd. We will have Alexis. We will have Ash on Trading Edges. They're with us next week. Still to come this week, we've got Gordon talking stocks. Maya, you okay to play that video?
Good evening, everyone. I'm Gordon Scott, here to talk about the U.S. stock markets. I have 4 charts I want to show you, which you're going to want to see, to explain what's going to happen in the next year in the U.S. stock market. Here we go. Now, this first chart comes from a book that I co-authored with Tony Turner, published in 2013. It was in that book that I first gave this research, which explains how you can watch the utility sector and compare it to the S&P 500 to determine whether or not a bear market is imminent, or conditions are ready for a bear market to appear. The research showed that if you see the utility sector outperform the S&P 500 at large for 2 consecutive months, and if during those same 2 months you saw historical volatility, that is regular price ranges as measured by the average true range, if you saw those things going up for 2 consecutive months, then there is a 90% chance that a bear market will occur in that following few months afterwards. Now, 90% doesn't mean 100%. The last time this lit off in 2015, markets went down about 3% more and then rallied all through 2016. So it's not always certain. And the market doesn't seem like it's about to crash from its recent lows right now. So what gives? Well, there are a couple of things about this, but with this signal having officially lit off, I'm a little more skeptical about the market conditions going forward in 2022. But I'm not the only one. This is Gina Martin Adams. She's worth following on LinkedIn, or if you watch Bloomberg News, you'll see her pop up. Anytime she gets on, you want to listen because she does good research. And she has a couple of charts that I think are worth looking at. Here's the first one. She did some research to say, what is the maximum drawdown that happens before a rate hike? And here you can see that in history, going back to 1973, anytime the Fed has hiked rates, what has happened right before it? Well, what's really interesting about this is the fact that where we are right now is the worst drawdown coming up in front of interest rate hikes. That's kind of interesting because it means that we might be in a temporary state of overreaction. We could see the market bounce up for a little bit. However, her next chart is this. She shows that what happens after rate hikes looks like this. The stuff before comes up to this point, and then from this pinch point right here, going forward, this is the historical activity that the S&P 500 plays out after there has been an interest rate hike, which is planned for right now in March. So you can see right there, the red line is the worst case scenario. The worst case scenario is only a 10% draw. So that's interesting, that after interest rates are hiked the first time, it only goes down 10% at the worst. I mean, who knows what will happen this time, right? But historically, the worst it's ever been is only 10% down. And that happens within the first month to 6 weeks after the interest rates are first hiked. So we're talking about from the middle of March to the end of April. Somewhere in that period, we could see as much as a 10% drawdown from that point. And then afterwards, it drifts higher. Not very much. The average return for the S&P 500 over that period of time from this point going forward is only 4%. So that's kind of dismal compared to what we've been seeing before. Even though we might not have a big old bear market crash where, 20, 30, 50% or something like that, we could see muted returns in the US stock market. I actually love those years because I'm not a buy and holder. I'm a trader. And what happens in these years is that you get a lot of volatility, a lot of ups, a lot of downs. Markets that just go straight up, there's not a lot of volatility. They just kind of creep up little by little. But this kind of stuff, there's a lot of ups and downs, a lot of opportunity for short-term traders to capture big moves that swing and pop right back. So I think that's what we're in for in 2022 is it's a trader's year. Starting that off, check out this chart that I came up with for the S&P 500, where we are right now. Now, I'm not a big pattern predictor guy, but I do pay attention when patterns are telling me that trends are about to change, and it coincides with historical research like what we saw from Gina Martin Adams on the Bloomberg Equity Minute. Well, here you can see we've got a higher high and higher low. Now the low is about equal. And if in fact the price action fails to make a new higher high, that will be a head and shoulder setup. Now that doesn't guarantee that the price is going to go down. However, if it goes down, and this has all of the textbook setups to start. We've got, the higher up, this quick down move on high volume is a really big indicator of potential reversal. And the forecast is that if in fact it were to drop from this low, it would drop from the same distance that the high point of that down to what's called the neckline would be, and that is what this red line represents. This would equate to about a 10% drawdown, and if it were to come at that period of time, it would square just exactly with Gina Martin Adams' research, which showed that the worst case scenario could draw this down in about a month to this level right here, below 400 on SPY. Now, that's worst case scenario. And that's kind of exciting to me, the idea that market's not going to do any worse than that. If I were a long-term investor, I'd want to stay put in the US market regardless of what happens, if I thought I knew that this was going to happen. I am not a long-term investor. I'm a trader. And so I'm pretty excited about the possibility of capturing this and then riding it back up later on. those are some of the things we're looking at ahead. Right now, between now and the time that the Fed plans to raise rates in March, then we're probably going to see a lot of pressure on stocks, a lot of herky-jerky volatility as different companies, similar to the whole Meta, Facebook thing and that Amazon thing, just the whipsaw back and forth of prices. I think more and more of that is going to come. And so there are a lot of opportunities. And what will that mean for the currency? Well, currencies are going to struggle because if in fact the U.S. markets are, if the U.S. Interest rates are going to increase, that's going to drive the dollar higher, and that's going to drive other currencies lower. So when I say struggle, I just mean relative to the dollar, other currencies are going to have more of a bearish tilt, would be my guess. And that's pairs like, the pound US or the US yen or the Aussie US dollar. So anything relative to the dollar will probably tend to show weakness throughout the coming year. And the big question will be, what will the central banks around the world do in relation to that? Will they leave their interest rate policies in place so that they can capture more of an advantage, an export advantage from being able to buy U.S. goods, or I should say an import advantage, being able to buy U.S. goods cheaply? Or will they struggle because now they have trouble selling goods into the U.S. market? And so they'll make a choice to determine, depending on what they do, whether they think they need to put stuff into the U.S. economy or take stuff out of the U.S. economy. And whatever they decide will determine their kind of interest rate policy and therefore how their currency performs. My guess would be that all of them will keep their interest rates lower than the U.S., which will put pressure on those currencies. They'll head down. It would be a good time to be long dollar currencies. Well, that's my read on it. Until next time, everybody, take care and trade well.
Wow, great session today. Wasn't it interesting to have the views of Ainslie on gold and Ainslie on oil and such different markets, and then have Gordon Scott come in and talk stocks. Some interesting stuff in there from mine. Some of those charts really interesting. Looking at a potential 10% pullback on S&P if the Head and Shoulders executes. Gina Martin Adams was the name of that lady. If you want to keep an eye out for her, and fascinating stuff. So how do we impact that? Well, we get about our business this week. Look to trade as Ainslie said, looking for a pullback in oil and a bit of a buy. Careful on gold, and perhaps with stocks, we're just looking to trade the volatility until we get closer to this interest rate hike from the Fed. Thanks for joining us, everybody. Great to see so many of you. Remember, look, guys, amazing content, free to the world. Tell your trading friends. Pop along and watch us every Sunday. You won't find better for this kind of price. Take care. Look after yourselves. Remember, stay calm and make good decisions. And if you do that, it will all work out in the end. Take care. See yous.